So we will straight jump into our final session of the day. While blue chip investing has long been seen as the safer, more familiar route, a growing number of informed investors are now exploring opportunities beyond the large cap universe, particularly within the SME segment, which is increasingly emerging as a meaningful contributor to alpha. Our next session, titled Beyond the Blue Chips, Demystifying the SME Space for Smarter Portfolio Allocation, will help us understand how this lesser explored part of the market can be approached with discipline, data, and a structured investing framework. We are pleased to have with us Mr. Abhishek Jaiswal, Fund Manager at Finavenue Growth Fund. With over 7 years of experience in financial markets, Mr. Jaiswal specializes in quantitative analysis, bringing a systematic and evidence-based lens to small and mid-cap investing. He leverages a proprietary quant model and detailed market matrix studies to guide stock selection, position sizing, and entry-exit decisions, constantly refining the framework as market structures evolve. What makes his approach distinctive is the integration of data-driven signals with the deep fundamental research conducted by the broader team, ensuring that every investment reflects both numbers and narrative. This blend of quantitative rigor and practical market insight anchors his process-driven approach to navigating the SME space with confidence. Ladies and gentlemen, please join me in welcoming Mr. Abhishek Jaiswal as he sheds light on how investors can tap into the SME opportunities responsibly and intelligently. Mr. Abhishek Jaiswal.
Hello, is it audible? All of us? Okay, so thank you so much, gentlemen, folks, ladies, for coming in this evening. Kamal and team, thank you for inviting. And I think the legends have really spoken. And while you all have been immersed with deep knowledge about markets, allocations, sector, trends, everything, take this one as a very basic initial, tutorial class to enter into SMEs. Think of SMEs as the babies and the crawling babies of the overall market. Your ability to identify one among them to be the cheetah of the whole world, that is where I step in. I define the traits, I examine them, I evaluate, I reevaluate, and I constantly investigate on that. And then only we land on certain ideas that, okay, this can be the next alpha in the overall industry. So with that, we can begin. Why we have specifically picked the SME. I mean, if the whole industry of India, the whole GDP of India is standing on a 4 trillion, SME alone is contributing 30% of that. Employing to the maximum level, exports to the maximum level, but still has not got the attention of capital market evolution and the due deserve in the institutional gap space. What I mean by this is, all of you must be investing in the small cap, mid cap, large cap. Okay? Even if you don't know the business that well, you can read it through the con calls, you can Google them, all the informations are well discovered. A layer above that, when you go into their holding parameters, you see certain institutions are there, right? The name of all the honorable ones, the Kotak, HDFC, ICI, Prudent, whatever, there's there. You automatically get a trust that if these guys are there, let's go out and invest into them. But what about the small companies? What about the nano space? They also deserve that institutional holding. Just like the small cap, mid cap, even the nano caps have the volatility in their earnings. But if the investor base is not solid over there, the market cap tends to shake. You as an HNI investor sitting in Mumbai, Delhi, or in some corners of our country want to invest into another part of the country in the very small companies. How well can you investigate that company? Can you see and open the doors? Can you look deep within the balance sheet? Can you know their clients and customers? Maybe some of you can, but not all of you. This is where an institutional gap has to be filled, that I as an AIF can come and I can provide you with that level of knowledge and integrity and backing that yes, whatever you are thinking, whatever I am saying is actually true. Interestingly, in the past 12 years, more than 1,300 SME companies have come in. 30,000 crores would have been raised. The net worth is around 3 lakh crores. It is very essential to understand that the CAGR that is compounding at close to 50 odd %. I'm not asking you to bet your house on this, but I'm asking you to have a decent allocation of capital, because the alpha that this is going to add to your overall wealth formation journey or the net worth, any word you use, I think the word I would like to coin is absurd, unimaginable. But that is what we are doing here. At the end of the day, right allocation, right approximation of risk can give you the alpha. Even if I like SMEs so much, I cannot put 100% of my capital into this, and neither should you, but you should not be bereft of this space. So pick a time frame of your choice and compare the SME against 50 mid cap and small cap, 1, 3, 5, 10, it is beating. And it's going to beat because the base is always small in the SME universe. A company which is standing on a PAT of 200 crores today, maybe in 2 years' time it can go up to a PAT of what? 240? In some exceptional cases 250, in rare extraordinary cases 300 as well. The valuation that you're paying to go from that 2 to 240, 60 or 300 is always, priced to perfection. So even if you find that opportunity, the valuation that you are paying for that is not going to cut to your actual wealth creation journey. The solution to both of these fundamental issues is solved in the SME space, but again, the filtration has to be really high. The next question often comes to your mind is, Abhishek, how much of a capital can you actually deploy into this space? To that answer, back in 2012 to now in 2024, the average capital in a single company being raised has jumped up from 10 crores to 40 crores. Even I as an institutional investor would not commit a whole 40 crores to that company today. I'll give what? 10% or 5% of that amount, which in my books is what? 2.5%. So what is the risk I'm taking? Minimal, at least to my understanding, but what is the alpha I'm getting? We'll see into that. It's very important to understand that the base is so small in these companies that even if you supply them with a decent capital, which in some sense goes up to 50% of their fixed asset or gross asset value, at the end of the day, you are supplying these promoters with the money in the industry of your choice, with the valuation of your choice, and they're performing for you. Through the later slides, I'll deliver you a case study where how closely as to we as a fund house would monitor our investment and why we have a deeper conviction even through the volatility of a cycle. But before that, when we as an institution enter, we have a very direct engagement with the promoter. At no point of a time a retail investor or even an HNI investor will be able to do it, but as a fund house, as an institution, we are able to do it. And in a way, we supply you with that sort of credible information as well. Our entry valuation through primary allocation is always, and by heart, always better than your entry valuation. When you want to look into the large caps, there is IT, banks, pharma, auto, consumption, and whole bit of Reliance. That's it. You're done. You cannot invest beyond to that, all right? But when you come into the lower bracket, the allocation in the different sector is so diverse that I can practically cherry pick my sector. I'll tell you a very basic case study, okay? So let's say we all have seen Westside, Zudio. We have seen Lenskart. Now everyone has an image of Lenskart in their mind right now. You also see their stores opening. I also see their stores opening. Surprisingly, you are looking at the store, okay? I'm not even concerned about the store. I don't even care whether that new store of Zudio or Lenskart, which is opened in your corner street, is going to be profitable in 2 years or not. What I actually care about, who is the person who is opening that store? Who's the company responsible which is getting the contract to open that store? How professional this value chain is. At the end of the day, if the consumption, QSR, and the whole brand retailing outlets is getting organized in our country, whether it is Metro, whether it is Mochi, whether it is Zudio, whether it is Burger King, anyone. I found a company in the SME space which is responsible with the contract to establish and deliver the stores. On the day of inauguration, my company gets the money in their balance sheet and they run out. The ROCEs of my company are above 50% and they are making money like a ATM machine. We took a large allocation in them. Practically the return that I made would blow everyone's brains out. That's the honesty. Okay, we would have made what? 3x in less than a year? But the ability to find that, the ability to understand the value chain, the ability to go beyond a normal picture which is right in front of you, many of us miss that. I am trying to just teach you that. If I am doing it, maybe just by following the anchor investors, you might be able to do it as well. I'll give you another case example. We are seeing roads getting front of us. We are seeing buildings, infrastructure, railway, whatever, whatnot. All of us would know some common companies, right? L&T, Dilip, Ashok, Adani, of course. Many of you would have wondered, the machines that are lying there in the compounds or in the roads or in the bridges or the highway, the cranes, where is this coming from? Who is the supplier of these machines? I found out, I invested in that company. Maybe in a period of 13 months, we would have doubled again. Not just in the terms of price. The stock price will double, it will. But it is chasing the earning. In both the cases, whether the previous one or in this one, the earnings have also doubled in the same time frame. So, in no scenario I am buying anything that is expensive. I am buying something at a very decent price, at the right valuation, with the right ROCE profile, with the right management integrity, and we are doing it great and we are making money out of it. The common filtration network, has to be, of course, anything that has to come in the Finavenue's criteria. These examples are just for visual representation purposes. Don't take it as an advice. Financial filters. Of course, if you will sit to me and ask me, and if you'll sit with any management and ask them that, please tell me your EBITDA margin. He says 15%. Will I believe that? I cannot. Left, right, center, I have to dissect your business and understand from your competitor, from an individual evaluator, whether that EBITDA margin is actually there or not. I even have to go into all the COGS element, all the expense element in your balance sheet, in your industry, to understand whether this is the true one or not. In small companies, sir, that is the moat. If you can balance your cost very nicely. Let's say even if your financials are good, governance takes a very aggressive check on me. No sort of unsecured loan should be given or taken from your books. No sort of personal guarantee should be given from the company. No sort of share pledging should be done. And promoter integrity has to be checked again and again. Because unlike your main board and large cap companies where there's a boardroom, discussion room, stat-based case studies, these small companies are run by motivated individuals who is all hungry out for growth. They are not startup savvy person, they are not good with decks, they are not good with communication, but they are real hard working entrepreneurs or businessmen who actually know that the cost of sweat is that high. And if you supply capital to them, they actually know that yes, this is the money I was so longing for and it did not know even existed, and now I can work with it. Finally, even the governance is good. How do I determine that this is the business I want to put my money for? At this size, I cannot even trust whether that business will do good or not. Okay, I have all this, that, dot. I believe that all of my companies which I put for in my SME bucket, their client list is definitely well esteemed. If that, companies which I just talked about in both the case studies, if in one the client was not Zudio or Metro or Mochi, I would have not put money into that company. If in second machine supplier company, if the contractors were local players in the tier 4, tier 5 cities or tier 3 cities, I would have not put the money. Once I get the conviction that the clientele of my business is much more strong and a highly strengthened players and highly aggressive players, I can put money there. While all of these filtration are like a level 1 to me, the level 2 is where the sweat lies even for me. I have to deal with your dealer distributor. I have to deal with your customer. I have to practically check your all audit trail regulatory patterns. I have to take your legal compliances. If you fail on any one of them, sir, you're out of my investment bucket. The level 1 and level 2 filters at Finavenue and personally for my investment framework is so damn strong that at the end of the day, you'll be surprised to look at the figures that everything is out. There is very little space for me to invest, but I'm highly confident about the growth there. And that is why I'm not chasing a very higher AUM at this moment. I'm not. But I'm chasing a very esteemed AUM at this moment. To take a look at the few figures, 23, 24, 25, honestly, these are my working years. In 23, we had 179 SME transactions. Post my level 1, level 2 clearance, Finavenue studied only 66 one of them. And Finavenue ended investing only in 8. In 8, you have made 83% against the market, which has made 36%. So yes, to answer your unheard question from your side, even with a closed eye, if I have put money in all of the market, I would have made money. But then how do I define my exit? The difficulty with the small cap investing is not about the entry. It's about the exit. The liquidity gets sucked out and you get blocked in. So the filtration that we deploy at the end of the day, I am damn sure about my exit. And maybe you can say that in first year, Abhishek, you would have done a pretty decent job. Moving on to the next year, 245 transactions. Finavenue ended up studying only 83 of them and invested only in 45. We delivered 2.5x of the market. Up until now in 2025, more than 226 transactions have happened where the average return of the overall market is around 12%. Finavenue has studied only 41 of them. Rest are not worthy for me because they are not part of Finavenue's confident ecosystem, and Finavenue's put stake only in 36. Even in my 36, my average run rate is around 26%, which is twice of what the market is doing. So in a way, I am the one person who gets to identify that this crawling baby will, someday be a runner. If you deploy the systems nicely of my level 1, level 2 framework, do all the due diligence tests very nicely, let's say all the rosy picture is there in front of you, from 21 to 25 so far, the number of SME IPOs have been rocketing up, but this has been my investable universe. right allocation, right entry, right exit at overheated valuations. That is the name of the game you have to follow. There is a certain allocation that you have to take. Let's not get overheated and stay sane. At this point, since I showed you a very big list, I want to take a minute to discuss one case study with you. This will highlight that how specific, to the detail that we monitor our investments. And I have taken one company which was even in the market even before the fund was started. I picked it up open from the market because I have that conviction on the business. The name of the business is Concord Control Systems. Think of it as a very, very hungry player in the railway ecosystem. Concord Control Systems, founded in 2011, the traditional business running out of Lucknow. I know both of the promoters, Gaurav Lat and Nitin Jain ji, hardworking people, jinko sweat ki value pata hai, as I keep saying. They understood well before time that the traditional business that they are doing cannot make them big. So they had to venture out of Lucknow and they ended up acquiring companies in Bangalore and Hyderabad. In a world where the traditional IPOs are raising funds for your working capital or your debt repayment or a little bit of OFS or things like that, they came up to us and said that the money that we have raised is for the acquisition, strategic acquisition. And I'll tell you on the monthly timeline that Gaurav ji has been so prudent about the capital allocation that I was damn right respect for that. So the legacy portfolio of Concord Control System was in the BLDC fans and the lights for the railway. The traditional question goes like, sir, आप ये पंखा और लाइट ₹1 में ही बेच सकते हो, 200, 300. आप अगर कल इसका रेट बढ़ाते हो, तो the railway ministry will not procure that from you, right? Of course, Gaurav Lat knew this. Even back then, there were 7 products of Concord that was approved by RDSO, where the product approval timeline was 2 to 3 years. Replacement cycle was around 5 years. So I was confident that this legacy portfolio business will have them have enough cash to keep their business going. But then they went up a notch further and Concord went on to acquire Advanced Rail Control Systems, Progota Systems. Then they went on to acquire Lab to Market. Then they went on to acquire Fusion. I just named out 4 companies for you. All of them are on the technology and sensitive side of the railways. So there was a product mix change which was playing in the Concord back in 22-23. I'm telling you what we have seen even back then, what we had a vision and how it played out really well. Even if you take at the industry level, from 24 to 30, Indian Railway has to deploy some 10 lakh crore worth of budget, capex, however you want to name it, in the country. In the just safety systems, the Kavach alone has to be deployed over 5,000 kilometers, 10,000 locomotives and 2,500 sets of the engines. It's a huge opportunity. 5,000 locomotive sets of our country are up for retirement. Okay, like आपकी जो गाड़ियों की रिटायरमेंट होती है 7 years वाली साइकिल, गडकरी जी ने बोल दिया है करना पड़ेगा. Similarly, railways में भी वो हुआ. 5,000 in India and surprisingly 50,000 worldwide. Now to replace that engine set, there is a cost of 35 to 50 crores. But if you can retrofit some of the elements, the cost is 8 to 10 crores. Gaurav ji understood this and he got up a company which is specifically working for that retrofit only. At formation, we have understood that back in 2011 to 2018 cycle, Concord was a traditional, legacy business working in the BLDC fans and lights. But they later acquired Progota, they acquired Lab to Market, they acquired Wheeled Diagnostic Systems Company. Okay, what is Wheel Diagnostic? To give you a very brief on that, Wheel Diagnostic is wheel impact load detection. आपकी जब ट्रेन रनवे पे तेज़ चलते जाती है तो व्हील का लोड जो ट्रैक पे होता है उसको स्टडी करना पड़ता है टाइम टू टाइम। आप जितने बार भी उस रेलवे कंपोनेंट के सिस्टम्स को चेंज करना स्टार्ट करेंगे, लोडिंग बढ़ाएंगे, अगर व्हील सिस्टम्स आपको अगर व्हील सिस्टम से आपको रीडिंग मिलती है कि देयर इज अ रिस्क, you have to monitor it very actively. So Indian Railways is getting smarter. Gaurav ji just understood it well enough. ठीक है? So with Gaurav ji I've spent a lot of time even, and from him I realized something even Steve Jobs had to say, that you have to go so close to your customer and then you have to tell your customer what they need, why they need, and then you provide it. So Gaurav ji has time and again reached out to RDSO and the railways, and he has been, a very key player in identifying certain technologies and told to railways that you need to deploy this time and again. From the foundation year back in 23, Concord had a stake of 26% in Progota. Progota is the one company which is in the risk anti-avoidance, so collision anti-avoidance systems. ठीक है? At that time, Concord's revenue was around 60 odd crores. Why care? Because they were working for the future. So of course I was interested. In 24, they acquired company in the lab to market, and they acquired company in the advanced rail systems. What does advanced rail system do now? They are in the distributed power wireless control systems. So when you have seen those large railways or large railway trains, when there are multiple engine sets, two in the front, one in the back, how do they smartly communicate? So there is a sensitive technology for that as well. Advanced rail is specifically into that. In 24, their revenue jumped to 85 crores, which was 60 crores in the previous year. They even landed a German technology tech transfer and got it in the metro overhead monitoring system. Everything is exchange disclosed. I'm not serving you with any sensitive information. In 2025, which was a proof of concept year for the Concord, I call it, Kavach, which was incepted in 23, is finally ready, submitted to RDSO for approval. Okay. Wheeled diagnostic is already deployed in Jammu and Odisha railways. And Concord's revenue is now up to 108 crores from previous year 80 to previous year 65. But this time, on 108 crores, their PAT profit is up 77%. The logic here is because now they are not selling your traditional fans. Now lab to market and advanced rail control systems has changed the product of the company. H1 FY26, which I call the inflection year for Concord. Finally, RDSO has granted approval to the Kavach in May 25. In June, July 25, Concord, right before the approval and order from the government of India, has increased stake in the Progota system, who is the owner of the Kavach. August 25, Kavach gets first field trial. September 25, Concord acquires another new company in the Fusion. Now Fusion is working in the electronic manufacturing service space for the Indian Railway, which alone can contribute 200 crores to Concord books. And now they have also entered into zero emission propulsion system. A lot of technical terms I can understand. But at Finavenue, we were tracking every move like a chess player move. We had it monitored by months, we had it monitored by revenue, by PAT and everything. So in this 22 to 25 period, Concord, which was doing a revenue of 65 crores 2 years ago, has done more than 80 crores in the H1 in this year. The EBITDA is up 3 times, the PAT is up 4 times, and gentlemen, Concord alone is up more than 20 times. It's an open Concord discussion again, where they are looking for 5x revenue from current price. I don't know how much of it will happen, but I'm very much behind the promoter because they are for their word, always. So it's important to understand that even the current order book of Concord, which is standing on 300 crores, I'm certain that it is set to deliver higher value again and again. By the way, Concord was an SME company. While now it's an open record, most of the investors would know that Finavenue is an active investor. Back in 2023, Concord was hovering around 400, 500 rupees. I bought left, right, center in Concord from 500 to 900. My average cost of allocation would be around 750. Next year, Concord rally from 750 to 1700. Did I sell? No. Why? I just talked about the events month by month, year by year, and I know how the numbers are going to shape up. All right? Something happened in the market. Of course, it's a financial market. Things are going to move. Concord fell from 1700 to 1000. 70% drop. I was happy because I could buy more at 1000. Next year, now Concord is currently pre-split. Okay, there is a split and bonus happening in the company. It has been prices now. Concord would be around 3200. So from the journey of 500, I have seen Concord going to 3200. From the journey of 5 crores PAT, in 1 year, they have gone to 22 crores PAT in half a year. So what I'm trying to tell you is that we know numbers, we know story, we know movements. How I deal with it is the right allocation. So at Finavenue, it's never about betting one on the big stock. I have a very prudent capital allocation policy. At any moment of a time, I'll not have more than 3% exposure in any one single stock or investment. I maintain high ROCE growth profile of more than 50 companies in my bucket. Every 6 months, 3 months, we have a review risk profile of all of the investments. And then time and again, I can decide to double up or shave it off from the books. So yeah, I think the return profile should be well known. And if it's not known, I'm hoping you will take a look at it with a curious eye. But I'll leave the floor for any questions if you have. Sure, sir.
Yeah, so see, the SME universe is very large, right?
I understand.
So you need to kind of refine it to arrive at a smaller list, and then you have to do all the due diligence which you have.
Of course.
You will need an army of people to do all of that efficiently.
Of course.
How do you manage that? Because that's ultimately that's the trick of the game.
Absolutely, absolutely. I've not highlighted about the team strength of Finavenue, my bad, my apologies. Finavenue has 15 deep research analysts. Apart from that, as you know, in my introduction it goes that I'm a quant person. Naturally, I know where to look through my systems. I'm supported by my beautiful friends analysts who have a systematic framework to work upon the ideas. We have offices in Mumbai, Raipur, as well as I have a dear friend over here, Tanisha Somani. She is based out of Guwahati. Okay? So we have one analyst sitting in one corner as well, because any moment of a time, in a month, 10 to 12 days, I'm on the field. My analysts are always on the field. In a world where people would be reading books, my masterclass is with the promoters. You have to understand what they are saying, not just once, but maybe 4 times in a year. So naturally, whatever you say, I will record it by you, milestone it on the timeline, define it within a framework, and then I'll follow it to the heart. The filtration, the templatization, everything is recorded in Finavenue. Any other question?
Is this entirely SME?
No, it's 40% of my capital which is in the SME. 20% of my capital goes in the pre-IPO market, where I have a strict SHA policy for 15 months timeline to listing. And 30% of my investment goes in the small cap market of 3,000 crore to 10,000 crores, where I believe a small cap like return, which you count in the mutual fund of 70 to 20%, that is always there. So a blended return of 20% goes to around 200, 40 to around 95, another 40 to around 15. Finavenue is a blend mix of list and unlist, and yes, I think we have delivered there. But the presentation was more around why SME, so I did not, bother to talk about my allocation policy or my distribution policy over there.
So you mostly invest in
No, that's not the case. All the SMEs cannot have pre-IPO. I mean, promoter dilution will go so high, उस promoter का interest खत्म हो जाएगा. मुझे उसका interest बनाकर रखना है. Any other question, please? Yes, Kamal.
So, all your past returns are on AUM of, I think, 100 to 200 crores.
Not really, okay.
Current AUM is around 500 crores.
Current AUM is about 500 crores, yes.
And obviously now, since the fund is, becoming visible to a lot of investors through such interactions like you mentioned to me in the morning that this is the first, session you are doing. Obviously, because of such high performance and your very confident personality, you will get a lot of AUM. And a lot of AUM coming in your fund will be a very big risk because it has 40%
Okay.
SME.
Okay.
And people will come, how will they exit?
No, it's not. The bucket that I have devised, the 40% bucket, so I even highlighted to the chart that the average fundraise now has matured to 40 crores. That means I can still do a check sizing of 5 to 7 crores. With the transaction deals that I highlighted, that in a year if I'm doing, let's say 35 to 40 transaction, 5 to 7 crores each, the value comes around 300 crores odd. 300 crores in a bucket of 900 crores is 35-40%. That alone, that bucket is growing by 35% CAGR. So I can still deploy capital till 900 crores of the AUM. Post 900 crores, Finavenue cannot take money and absorb this style of strategy. It's difficult to deploy post that, I'll be honest about that. But till 900, I don't see any trouble. So whether I grow organically or with the fresh money, it's all right for me. But at 900, I'll be open to my investors with my letter that the return that you have seen so far is a bliss that we cannot have anymore. So it's okay. The blended return post that will be around 23% or 25% maybe. Because the small cap selection that I still have with my quant edge is still above yours or still above the market expectations. I mean, when I picked Inox Wind, when I picked HCG or Techno Electric, it was undiscovered. It's okay, we have made money there. I don't have it in my portfolio anymore. I have new investments in my portfolio.
What is your view on SME market from here onwards? Like SME has given more than 60% return for, I think, a decade, year on year. We also see some
So the beauty about that is it's always, the returns are derived by the composition. If I keep the same 100 portfolio bucket and I want that to perform every year with 50% return, it cannot. Just like you said with my companies or my fund size, after a while I cannot, they cannot. But with SME, the new companies that are coming, they again have a small base. If you are doing primary infusion in those set of companies, how can you not make money? Your selection has to be strong. That is why I specifically showed in the slide that why a crude and raw selection is the secret of the game. With closed eye, you can make a decent return, but you cannot make a defined exit. With the raw filtration, you will make an absolute return and an absolute exit. So I think if anyone has the ability to understand the whole transactions of the market and the volume terms, you give me a 10 days notice and I can dilute 25% of my capital. You give me a 30-day notice, I can dilute 42% of my capital. You give me 3 months time, I can dilute 75% of my capital. The last 5% will be dead, I'll be honest. The 20% is unlisted, I cannot dilute. It will take 15 months for me to do it. But that will be a bank run scenario. Institutions are built on trust. So I don't expect all of you will ask your money back from me if I'm doing that good. Any other question?
The returns of the fund are like quite high, very attractive.
Thank you.
Obviously, I as honest advisor do not want investors to fall trap to the highest return, but at the same time do not want them to miss such a highly potentially return product. So I want you to kind of give your final disclaimer or whatever expectations want to set. Like whatever they hear from you is coming from you to them in terms of
I mean,
risks.
it's like asking, I want this ice cream to, I expect this ice cream to taste good, but I'm afraid it will not taste good. Okay? But I want it to taste good, you're saying that, okay? So honestly, folks, if you understand the bucket philosophy, all the money that you're going to put in, every cent of money that is going to come in is absolutely going to be deployed in set of companies where the ROCEs are extremely good. Either the market appreciates it ahead of time, or the reserves of the company will go up, the valuation will further go down, and the catch-up will happen later. The blended average holding or the blended valuation multiples, whatever you want to think of, PE, PS, PB, EV, EBITDA, whatever it is, in all terms, Finavenue has the ace. There is approximately 46% growth in the bottom line of my companies with the holdings that I carry. The average multiple of them would be around 17x for the FY26. A company that is growing by 40, I'm holding at 17, I have to have some faith in the market, anomaly that it will match up in time. And every new money that I'm even putting in the business or in the fund today is again at the same multiple only. So I am very precautious about the valuation that I'm going to buy these companies at. I am more precautious about the allocation I'm going to make into that, and I will be super vigilant about timely monitoring it. So there are confidence-based meetings. There is an IC committee with us. Of course, I am not a one-man show. I have 9 years experience in the market, and along with me there is Madhusudan Sharda ji, who is twice of my age. He carries twice of my experience, in fact thrice of my experience. So I honor him. He's head of equities in the fund. We have Aditya Parak, who's a rank holder chartered accountant, 15-member analyst team, of course. So decisions are not suo moto driven. They are process driven. No, that was not the case, because I specifically highlighted that, more than 30 of my companies have been 200%, okay? 5 of my companies have been 500%, and rest everything is on the 30% slab. I have not invested more than 3% of my capital in any single idea, not in history, not in inception, not even in my lifetime. Even on a 50% drawdown on any particular idea of mine, it cannot drain my capital out. That doesn't mean that I have not seen failures. Particularly, I can share 1 or 2 examples if the time permits, but I'll have to take Kamal's permission for that. It again goes on the case study, but if you have any other questions, sir was asking something.
Is it a closed-ended or an open-ended?
It's an open-ended fund.
Open.
Yes.